is Dominic, and I'm going to be talking about the petroleum industry analysis today for the Chevron Corporation, and this is for my company and industry research project.
All right, first let's talk about the market structure. Chevron is a major contributor to an oligopoly. It has a standardized product, which is gas and petroleum, so on and so forth. Few number of firms in the market of petroleum, so you have Shell, ECON, BP, and then you have huge capital requirements, which are obstacles. Rivals do not deviate too far from each other in price, so each company does not try to differentiate their product because they want to keep it at a constant level. And the price for gas for different companies is usually very minimal, within 10 to 20 cents. And for example, OPEC, which is an agreement between countries across the world to regulate gas prices, is a collusion which is also part of an oligopoly. All right, now let's talk about a change to the market and how it's been introduced. We have hybrid and electric vehicles. The demand and cost curves might have gone down slightly because of this, but it hasn't been extensive. So first I'm going to show you a little bit how it happened. So let's say the demand for gas goes up. So that means our demand curve is going to shift this way. And let's say our demand goes down. It'll shift this way. Now that goes the same for cost. Let's say the cost of gas decreases. That means it's going to go this way. You have the arrow pointing that way, and if the cost of gas increases, it's going to go this way. And as you can see, these kind of fluctuate. So let's say, okay, we're down here at cost. If the cost is lower, the demand is going to be right there. But say the cost is higher, demand there. And if the demand right here gets lower, the cost is going to increase. Now let's address some of the variable costs. First, you have to purchase oil, because not all companies drill for their own oil, they purchase it. They have wages and salaries to pay their people that work for them. They have power, transportation, taxes. Next, they have leases for things that they own, research, development, advertisement, administration costs, legal costs, so on and so forth. Now, let's talk about the impact on the cost curve. As you can see, economic profit is right here. And this is pre-impact of the hybrid and electric vehicles. So this is before they even existed. This is their economic profit. But as you can see, as marginal cost, you got the average total cost, average variable cost. And now, as that goes down, you're going to see that the post-economic profit is still going to be a profit, but it's going to be a little less, but it's still going to be a profit. Although all the marginal cost, average total cost, that's all shrinking, but it's still going to be a profit because it's gas. People will still always use gas until electric vehicles and hybrid vehicles become something that they want to go through with. Overall, Chevron will not make money if costs go up. But since there is no alternative to gas, they are going to still make money. You will make money still because you will keep ATC low enough that MC equals MR, marginal cost equals marginal revenue point, and marginal revenue will be high enough. If raw material costs do not go down, but the cost of sales go down, the company would go under. But in theory, the price will drop. This would further reduce profit margins and contribute to short-term economic losses. And hybrids and electric cars overall are not attractive enough.
Okay, so to back up my claims on hybrids and electric cars overall not being attractive enough to buyers, I got some statistics to prove it. According to Reuters, 4.5% of the world's vehicles are electric. Therefore, the petroleum industry will not see a threat from their competition anytime soon. And that's pretty logical. According to Reuters, a BP statistic stated that oil would remain the dominant transport fuel, and they expect 87% of transport fuel in 2030 to be petroleum-based. So 15 years from now, 87% of things that are running off petroleum are still going to be running off petroleum, meaning that the hybrid and electric cars won't have a significant impact on the petroleum industry. And according to plug-in cars, at the moment, low gas prices are hurting electric vehicles. I know that it's fluctuating right now, but overall, the gas prices are still fairly low, and because of that, the electric car industry is not doing as well because people now have an incentive to continue using petroleum-based cars because gas is cheap. When it's at $2 to $3, people are going to still ride their cars. And that's basically it, guys. Thanks for watching.